Thanks for joining today's webinar. My name's Tom, and I'm going to be your host today as we take a look at finding hidden deals in 2024. Before I turn things over to our moderator, Vashi, just want to cover a few very quick housekeeping items. Firstly, this webinar is being recorded, and we're going to circulate a copy of the recording tomorrow, along with the report that we'll be referencing today. Secondly, we do have some time reserved at the end of session for Q&A discussion, but please feel free to drop your questions in as we go through. There's no need to wait until the end to submit your questions. And lastly, if you do happen to experience any technical difficulties over the course of the webinar, please use the chat function to let me know, and I will try and do my best to assist. Great. Well, with that all out of the way, I'll turn over to our moderator, Avashi, to get us started.
Thank you very much, Tom. Welcome, everyone. My name is Avashi. I'd like to get started with a couple of intros. I'll not spend too much time on it because we want to get into the conversation. And then, as Tom said, we'll take questions at the end. So start off with Finquest. Many people on this call will know who Finquest is, but for those who are new to us, we are a deal sourcing provider that leverages data, AI, and people to find proprietary acquisition opportunities for our clients. Now, the reason we're hosting this webinar and these webinar series is because we're passionate about M&A and its potential to unleash the private market. And part of doing that is providing a platform for discussion on this ever-evolving landscape. So onto my panel. First up, we have Nadeem Malik. Nadeem is CEO and co-founder of Sutton Place Strategies by Bain & Co. And for those who aren't familiar with SPS by Bain, they are an information services firm that helps private equity firms, lenders, and M&A advisors optimize their business development effectiveness. Nadeem set up SPS in 2009 after creating market research tools at American Capital that actually drove their deal origination. And aside from that, Nadeem has a long career in financial research and financial information products. So he very much knows his stuff when it comes to deal sourcing. Welcome, Nadeem. Glad to have you here.
Thank you, Arvashi. Glad to be here.
And next up, we have Robert Crichton. Rob is MD at Onyx Transportation Partners. That is a new platform focused on investing in transportation-related assets. Rob has over 15 years of experience in private equity investment advisory services. And prior to Onyx, Rob was a principal at Littlejohn & Co., where he was responsible for sourcing, execution, and management of LBOs and structured equity investments. Prior to that, Rob also earned his stripes in investment banking at UBS and a few other places as well. Pleasure to have you, Rob.
Thanks for having me on, Rasha.
Perfect. And last but by no means least, I'd like to introduce you to Finquest's very own CEO and co-founder, Tanguy Lesala. Tanguy started Finquest 8 years ago now to disrupt the deal sourcing market. And prior to that, among other things, he served as a consultant advising on post-merger integration and joint venture projects. Tanguy is also a seasoned speaker and thought leader on AI, deal origination, and the evolution of the M&A industry at large. Tanguy, glad to have you on the panel.
Thank you, Avashi, for the introduction.
Perfect. Okay, so onto the conversation. I want to set the scene a little bit. A few months ago, Finquest published a white paper on navigating the untapped potential in the lower middle market. And all of that was based on the data we had collected through thousands of CEO interviews. One of the key takeaways there was just how much of the market was left untouched. I'm deliberately not saying how much it was because we're going to go into that in a bit. Now, at around about the same time, SPS by Bain had published their 11th annual deal origination benchmark report, which revealed an equally astounding number of deals that remained unseen and left on the table. So similar conclusions, but talking about an entirely different ends of the spectrum in terms of types of target companies. Now, seeing as we're going to be taking a look at what the data is telling us about deal sourcing in 2024 and what we need to know to be successful, I'd like to start by examining the landscape that data came out of. What were we experiencing in 2023? And then also what each of our panel is expecting from 2024. And Nadeem, I'm going to come to you first. Will you kick us off there?
Yeah, absolutely. I think it's safe to say that 2023 was a rough year for deal making, Arvashi. Economic uncertainty, recession fears, high cost of capital, geopolitical turmoil, these do not make the right ingredients for a robust private equity and M&A deal-making world. And the data proves it out. According to SPS, deal activity in North America, consisting of both control and minority transactions with either private equity or corporate buyers of at least 5 million of enterprise value, was down 20% after being down 14% in 2022. Q4 2023 activity specifically was down 45% off its peak, which occurred just 2 years earlier in Q4 2021. So that's the current backdrop. Looking ahead, from what I'm hearing in conversations with clients and some surveys I've seen, the expectations for 24 is for deal activity to increase. And I think it's safe to say there's definitely an optimism out there, especially on the part of PE firms.
Thanks, Nadeem. Tanguy, do you want to add anything there?
Not much. Well, Nadeem, well done, right? I think there's just to complement a little bit, agree with everything. We've had also seen stats, in terms of private equity activity going significantly down. I think the mix of deals as well in 2023 was a bit different than the usual, platform, and there has been a little bit more carve-outs and a little bit more opportunistic investments than sort of structured in a way. The other thing as well, I think, is looking forward. Everyone talks about the ask and the bid ask spread, right? And everyone is kind of anticipating that it's going to progressively lower. Then also the access to debt is progressively going to be more open, and that should sort of make the pump work again, right? In terms of being able to exit, being able to reinvest in private equity. And I think that's what has been missing in 2023. And I'm looking forward to it in 2024.
Rob, what are you seeing on the ground?
Yeah, I would agree with all that. I think 23 was a tough year. As we think about 24, it hasn't really started out of the gates particularly strong. And I think that, going back to Tanguy's point, there is a question around, what are the businesses worth? And I think there's been a disconnect for all of 23. I think it's persisting into 24. Our view is that's going to narrow at some point. It's not entirely clear whose direction it's going to break in, whether it's buyers are going to get antsy and want to deploy and spend up, or sellers will ultimately capitulate. But we think the spread will narrow and have optimism for the latter part of the year. I think that the main thing for us, though, it really just means that we've had to be more creative about where we look for deals. I think people have been less willing to bring things to market. And so, we've had to give a lot of time thinking about where are we spending our time and where are we generating deal activity.
That's a really good point, actually. Let's talk about the definitions here. How are you when you think about deal sourcing, what are you thinking of?
Absolutely. So when I think about the universe of deals, you can think about it existing on two axes. Now, on one axis, you have just a level of competition. So you can move from broad auctions to more limited processes down to proprietary deals. And the other axis is going to be the size of the business. And so as you move up from smaller to large, you're going to see that the larger deals tend to be more broadly marketed. The proprietary deals tend to be on the smaller side. And it really comes down to the size being the biggest differentiator for most of what we see. And so as we think about doing platform deals versus add-ons, you tend to have more of the platform deals being more heavily intermediated. And what we see is that there are always going to be a group of intermediaries who cover a high percentage of the deals that we're going to evaluate. In a softer market, though, you need to make sure that there's a lot happening in the longer tail. And we need to make sure that we're in front of that and we know where that's happening and how we can participate in those limited or non-processes.
Nadeem, anything to add to that?
Yeah, I think building on what Robert is saying, we view deal sourcing as a spectrum. Typically, the conversation is around banked or heavily auctioned deals or proprietary deals. We kind of view them as bookends on a spectrum, on a way of deals can source, moving, starting from one side on the heavily auctioned deal to maybe quieter processes by boutique advisors, to alternative sourcing channels such as lawyers or wealth managers, maybe direct to private equity sourcing, and then all the way to the direct proprietary opportunity. Like Robert said, the larger the deal in general, it's a higher likelihood that it'll be intermediated. And the approach can also vary between add-ons and platforms. Add-ons tend to be smaller, more often directly identified. On that note, I'll say that we've seen a compelling increase in add-on activity by PE firms in the last 5 years as a result of the buy and build or roll-up strategy. According to SPS data, in 2023, PE firms completed 2.6 add-ons for every platform, which compared to 1.8 add-ons per platform just 5 years ago. So I think the growth in add-on continues to increase year over year.
Hongi, anything to add to that?
Well, yeah, I completely agree with the sort of the spectrum, right? And I think between the you can also add another one maybe, which is proactive versus reactive, right? And I think there's a trend, right, towards being more proactive, whether the deal is intermediated or not, right? So because the market is becoming more competitive for a limited set of sizable targets. And so the need to differentiate, the need to talk to the company before the company comes to market, and having built relationships, with those companies is becoming more and more critical as a way to differentiate. So I think that's one of the trends, or one of the elements of the spectrum. So I also see that as a continuum, right? I think that sometimes the fact that even the small companies being approached consistently, increases the pressure for them to say, okay, now it looks like there's a lot of demand, so we're going to create a process, right? And so some of the proprietary deals can become intermediated, and at the same time, I would not also say that all platform deals are necessarily intermediated, and I would not drop the chance of going proprietary, even if it's much harder, even if the probability of it happening is lower, right? So agree with everything that has been said, just adding a little bit of nuance or maybe another dimension. And I think the proactiveness now versus the reactiveness, I think the market has been easy in a way, right, over a long period of time, and now every one of our clients is becoming more active and strategic in terms of how they approach deal sourcing. And I hope we're going to talk more about that part, right, in the conversation.
Yeah, indeed. So that's a good thing to have in your mind as we go through this: platform versus add-on, large versus small, reactive versus proactive. So let's go into the data now. But before we take a look at the data, I want to take a quick poll to frame up this section. I'd like to look, Tom, if you could launch the first poll, please. The question we'd like to ask is, what proportion of target market deals do you expect you're seeing? We've got a few percentages there. I'll give you a second to do that. Don't think too hard about it. Tom, how are we doing for votes?
Yeah, we've got 30 responses and climbing. The 0 to 30% currently the biggest share of the votes. 46% saying 0 to 30%, 36% saying between 30 to 60%, and only 15 saying 60 to 90.
Okay, that's fantastic. That's really interesting. We'll let that run for a second, or have you stopped that now?
I'm just going to share the results now.
Okay, great.
Almost everyone had.
Okay, there we go. So the results should be showing on screen for you. As you said, up at the top, you got the 0 to 30. Does that surprise you, panel? Nadeem, do you want to go first?
Yeah, it's funny. When I was launching SPS back in 2009, I remember meeting with a very prominent sector-focused private equity firm, kind of pitching this concept that market coverage might be lower than you might assume on the deal front side. And I was told that their perception was that they see 99% of the deals that are relevant for them. So eventually they became a client, and a long-term relationship. It's been good, and it's wild for me to see these polled results on how that perception has evolved over the years. So maybe this would be a good time to show the Dober stats, just kind of frame the conversation while Tom pulls those up. I just wanted to give some context. Every year we produce the deal origination benchmark report, or we call it the Dober, for clients. What you see here is a very high-level summary snapshot of the latest edition from fall to 2023, so just a few months ago. It's something we've been publishing for a decade. It's designed to give a review of a client's deal sourcing, how effective they are they getting better? Are they top quartile? Do they need to cover more intermediaries or alternative sourcing channels? Is their deal flow greater or less than their peers? And of course, how they can better prioritize their time moving forward. So that's what the DOBR is. Back to this summary page, one of the key metrics we use is market coverage, which is the share of relevant deals closed that a firm sees in its target market. And so this latest analysis was derived from 167 PE firms that qualified for inclusion. It's broken out into 8 peer groups, which you see on the bottom here. And the way this chart flows from left to right, generally speaking, is from larger to smaller funds, which is why you see coverage in terms of median, max, top quartile drop for firms focused on the lower end of the market towards the right, which makes sense because the lower end of the market is more fragmented and more difficult to cover. So the main takeaway here is that most firms are still missing over 75% of the relevant deals they'd like to see. And that's only for when the deal was intermediated and was in the buyer's target market as they've defined it. So if we were to include proprietary deals without an intermediary, the coverage would drop dramatically. So if you're not familiar with SPS or this report, it's probably going to come as a shock to you, but based on the poll results, I think people are kind of expecting this at this point.
Yeah,
go ahead. Turn it
No, I was
back
going to
to
say we have an enlightened group here.
Yeah, for sure. We can go to the next slide where we're talking about the stats really quickly. So this slide summarizes some key deal sourcing metrics that I thought might be interesting for the audience. The market coverage on the left side box on the top shows top quartile market coverage, median, max, and minimum for different cuts of the data. When it was any kind of intermediary, when it was a boutique intermediary, when it was an active intermediary, as you might suspect, when the seller is represented by a boutique intermediary, this is a firm that only does 1 or 2 deals a year, the coverage drops pretty dramatically because they tend to, generally tend to be more quiet or limited processes. Sticking on that left side, we're showing how coverage has changed in the last 6 to 12 months, and then what the coverage might be for broad versus moderate versus limited processes. And then the right box is focused on more general key deal sourcing metrics, not based on market coverage at all, like the number of platforms and add-ons closed, annual deal flow. This tends to be still the most prominent measure of how robust your pipeline is or how good you're doing on deal sourcing. How many deals are you seeing? And what is its closing rate? How many unique intermediaries showed you deals, and so on and so forth, and number of BD professionals. So these are some summary stats derived from the latest report to kind of help put this in context. This is why SPS exists. This is why Finquest was, market coverage is very low, and we can help our clients to kind of penetrate those markets and chip away at those percentages.
Rob, I'd like to come to you and get your perspective on these numbers. What are you thinking when you see that?
Yeah, I think from my perspective, it resonates. I think there's probably some nuance around how many deals that are kind of within the platform spectrum are you missing versus the add-on, because I think there may be some blending. But I think the general point is, there's a lot that's happening that you're not seeing, and it comes down to kind of, are you making the best use of your time to create the highest probability of something that can close? And so I think it just continues to resonate that the coverage can be improved at any given point, and there's a lot that's not falling into your lap the way you might like it to.
Hongi.
Yeah, it's interesting because that's one part of the market that by definition we don't touch at all, right? Because we're coming from the absolute other end of the spectrum, which is finding companies and not going through intermediaries, right? So it's interesting to see that even on the intermediary side, there's a lot that is left on the table, or lack of awareness, but by advisors on who the relevant investors and buyers would be. So I think it's interesting to see that even when the market is, looking at larger companies, because the intermediated deals are so often, there's a correlation between intermediation and company sizes. There's still a lot missing, right? So it's interesting. I was surprised, in fact, when I saw those numbers, because it's a pretty well defined. You have thousands of advisors, you don't have millions, right? And so the order of magnitude that Nadim is playing with in terms of data set versus Finquest, where we handle 200 million companies, is nothing to compare. Yet the market is inefficient in the sense that, you know, investors, it should be more transparent, right? That I think that's the outcome, that's the learning.
So let's take a look at the other side of the coin. We've looked at the intermediated space. Let's look at the proprietary space. Tom, do you want to flip to the next slide? Tongi, this is you.
Yeah, so here we're not as sophisticated as SPS, right, in terms of the metrics, and I think there's a good reason for that. It's a harder market to approach, and so here what we're doing is we are looking at what we call the buyer interest, which is a measure of the competitiveness that investors and corporate buyers are facing when looking into a target market, right? And here we're looking at the responses from CEO interviews, so thousands of CEO interviews we've done on behalf of our clients. There are companies that fit with their investment thesis, whether it's for a bolt-on or a platform, and the results are quite interesting, right? The question that is systematically asked to a CEO when we are speaking with them is basically, how many times have you been approached by a corporate or private equity investor in the last 12 months to discuss an exit, right? There's this little part is missing, but this is the question that is asked to the CEOs, and the distribution of answers by company size is what you see on the slide, right? So not very surprisingly, the larger the company, the more the company is approached, right? Generally speaking, several reasons to that, right? There's you know, the companies that are larger are more easy to identify as well. They're more attractive from a buyer's perspective, right? They move the needle in terms of top line, in terms of synergies, and basically everyone is trying to buy companies that make a difference, right, to the platform, or even for corporates. I know there are a large number of corporates attending this call, is the same thing for corporates, right? So there's more appetite for the larger companies. Now, obviously, what's interesting here is there is a significant outlier in the 50 to 100 million company revenue range, right? And so although on a company that would be 100 to 200 million would be approached about 25 times a year, so say 2 times a month, to put it simply, whereas a 2 to 5 million company would be approached about once a month, right? So it's a difference in terms of order of magnitude. In the 50 to 100 million, it's a noticeable increase. And there are rational reasons for that. One, there's a scarcity of larger assets, so everyone is going down, right, in the lower middle market. Everyone, whether the strategics or the platform or the private equity, so they're looking at smaller platforms and sometimes consolidating several platforms to build a bigger one. So that's one of the reasons. Two, looked at by strategic buyers, and also they are actually great candidates as bolt-ons, right? So interestingly, in the range of 50 to 100 million, you start to see companies that have a track record of EBITDA, that have solid management teams that can become platforms in their own rights, and at the same time, they are great candidates for bolt-on. And so there is an inflation of demand basically from investors into that segment. And that shows, that also shows that you may think that there is, these companies are, identified and approached all the time, which is true. But in fact, what's more interesting is to look at the distribution of answers, right? And if you can move to the next slide, Tom, that would be to explain the distribution of answers. So it's not like every company is approached the same number of times per year. In fact, it's very, very segmented. So if you look at the companies between $100 and $250 million, for instance, which is the bar chart on the right of the graph, you see that there is basically a number of companies, about 40%, that are approached more than once a month, right? 13 times or plus a year. And then you've got more than 20% of the companies that are barely approached, and that is to show, right, a little bit like Nadim was sharing here. It's like those companies are not identified, right? And back to Nadim's comment about the sort of the change in attitude and in terms of the admission of not knowing, right? I think we see that a lot with our clients as well. There's no ego anymore, right? It's like the universe is so massive that no one can pretend to know the entire universe of relevant companies. And that's exactly what we're seeing here, right? We're seeing that there are a number of companies that are constantly approached. They're basically covered by the same databases, right? The usual suspect. And then you have a huge number of companies that fit with the investment thesis. Sometimes they're large as well, and that are just left aside, right? And so that is a very both bothering, right, in terms of the inefficiency of the market, but at the same time, it shows how much opportunities there are out there to continue to make acquisitions. And the reservoir basically is massive.
That's really interesting. Rob, I'd like to hear what's been your experience of this on the ground?
Yeah, but I think this is consistent, and this page is certainly shows something you'd like to see, which is there are a bunch of companies that are off the radar that fit within your strategy, and they're sizable. And so, our experience has been that you don't know to go talk to them. It can sometimes be hard to figure out how to best go talk to them if you have an existing industry executive who has a very thick Rolodex. That's one way, but a lot of times you have to look to a data provider to try to identify these names and generate contact points. And so for us, one of the ways we have approached deal sourcing, I think there's a question that came in from the audience around proprietary deals, is that you will go to a third-party provider to facilitate a roster as kind of a first step. And then depending on, like a Finquest, making calls for the introductions. And so we found that's very helpful in some of the strategies and themes that we're pursuing at the moment, where you're trying to maximize or trying to make the best use of your team's time, and putting some of this effort onto a third party is actually really productive.
So, Rob, you were taking a question that came in from the audience just for reference. Said, while proprietary deals are desirable, they take up a lot of time and effort. If your team hasn't got the systems in place to go out to hunt for deals yourself, where would you recommend starting? So that was your answer to that question, was it, Rob?
Exactly.
Nadeem, Tongi, do you want to add anything to that question?
I think if you think about getting back to the spectrum, right? The sort of the intermediated versus proprietary, the passive versus proactive. I think the challenge when you're looking at finding deals is there's one of efficiency, which pleads for the intermediated deals, right? When you have an auction, there is a deal in the end, most probably, right? But you're competing against your peers, which translates into lowering that probability the more peers there are, right? That's the principle of an auction. And at the same time, potentially increasing the price compared to a proprietary deal. So it's not like it's all good or all bad. It's both have advantages and disadvantages. And when you look at proprietary deal sourcing, yes, sometimes it's like, where do you even get started on that, right? Do you subscribe to databases? The number of channels that people use to get those proprietary deals is insane, right? They go to expert networks, they go to conferences, they rely on management, coming back with information on the market, consultants, etc. And I always say that when you have a number of channels or a number of ways to try to make an objective and none of them is actually working comprehensively, it means that you haven't cracked it, right? And you don't even know, even though you do all of that, you don't even know if you have covered it. And that's where I think that's where the market is and that's what this graph is showing, right? The potential is big, and even though you do all of that, those traditional channels, and even if you're creative in implementing them, it's going to take a lot of time, right? You're going to get the opportunities when they come. And the point here is to say, how much power do you have as a buyer if you have all those opportunities at the same time now, right? Versus waiting, in a sense that all these initiatives you're putting in place bring deals back to you. And so the point is, you can't strategize. You can't decide if that company is good or not. You don't know if there are others that are better, or if you should actually fight real hard on this one because there's nothing else available out there. Right. And I think that's where the market for me is changing, right? It's changing, and our clients realize that the ability to sort of map now to be able to be action driven on those targets and proactive and fast, it has incredible value.
I think one last comment on this slide. First of all, I find it very eye-opening. I know I shouldn't find it eye-opening and surprising, but it's not a market that we cover. I think if I was a buyer or a sell-side bank or broker, something like that would get me very excited because there's a lot of untapped potential. Before starting SPS, I was a private equity business development professional for 6 years. So that means I've been involved in deal sourcing, for over 20 years and have worked with hundreds of firms now with, as a data and technology provider. Like, going back to the full spectrum of deal sourcing channels, our approach has always been, and you can't really turn your blind eye ideally to any one part of that channel. Ideally, you want to see a great opportunity, the right opportunity, the one that you are perfectly matched for. Ultimately, you don't care really how it came. You just want to make sure you've got as many bases covered so you didn't miss that opportunity, because the cost of missing that opportunity is so high, and you don't know when it's going to come again. And what I've found on that spectrum, putting data and tools and technology aside, like on the intermediated channel, most firms have people internally covering that aspect. And in general, like, there's always exceptions, most firms are using external people or resources for the direct sourcing because it is so much more challenging and so different. So the rise of the business development professional that's occurred in private equity in the last 10, 15 years is it's huge, it's massive, and it's been a great partnering with those firms over the years. But in general, the BD professional tends to be focused on the intermediate market, and that's why tools like Finquest can help on the other side, where it's you just need a lot more data power and manpower to get it done.
Okay, now we've talked about the historical, and it feels like a good time to shift into the sort of the forward-looking part of the conversation. Before we go into that, I want to do another poll, please. Tom, if you could put up the second poll. And this is specifically around, well, I suppose proactive or reactive direct from sponsor sourcing. So what is your strategy around direct from sponsor sourcing? I'll give you a couple of moments to fill that in. And if it's a mixture of both, then let's pop in proactive. Okay. Tom, we ready to share?
The responses have been slightly slower to come through this time. People are obviously just digesting the discussion, so maybe we'll give it 5 more seconds.
Okay. All right.
Well, I think we've got about just as many as we're going to get there. So 26% saying reactive, 52% proactive, and then 21% not active. Let me go ahead and share these real quick.
Interesting. Thank you. Panel, is that what you expected?
Yeah, I would say that we've seen a growth in direct to sponsor sourcing. It's become a core part of a firm's value proposition for clients. Originally it was really around intermediary coverage. Over the years, it's evolved to alternative sources of deal flow like M&A attorneys. But I think direct to sponsor sourcing has become more and more critical. This might be a good time, Tom, to bring up the slides on sponsor. If according to our data, there are currently over 5,100 platforms that were acquired by PE firms between 2012 and 2019 that are still being held, and are, logic dictates are going to need to trade again soon. And it's very important to be able to sift through this granularity, deal sizes, sectors, geographies, maturity, PE professional whose portfolio it's in, contacted for any potential warm intros into that, and really get smart and more proactive on this sourcing channel. And we are definitely spending more time with our clients to do this. Part of which you'll see, part of the reason why you'll see in the next slide, which shows that PE hold periods are continuing to extend. This should be no surprise based on all the data and commentary we're hearing about PE firms in a wait and see mode regarding selling their portfolio companies. And going back to where we started today's discussion on the outlook for deal activity in 2024 being optimistic, This is one of the driving factors for that. This suggests a buildup and potential surge of PE-backed opportunities coming to market for a variety of reasons. One of the major ones is including the need on the part of GPs to return distributions back to LPs so they can continue to allocate dollars towards fundraisers and PE fundraisers and kind of keep the ecosystem in equilibrium, if you will.
Thanks. Tongi, do you want to add to that?
Well, I think what Nadim is sharing is basically a representation of the increased penetration of private equity in the US in particular, right? If you look at the PE penetration, it's like double in the US compared to Europe, and then another doubling compared to Asia, right? In what we see in terms of the PE coverage. So I think at some point all these portfolios have to come to market, and so the cumulative amount of portfolios that are on hold, right, is increasing, and obviously that is generating another channel of deal sourcing, right? That needs to be taken care of, and that needs to be piloted. So I think it's really interesting. Completely see as well with our clients, I mean, it resonates a lot, right? The average holding period is increasing, and in fact, the way our clients react to that is from our perspective, and in terms of proprietary deal sourcing, it's interesting because some clients are like, okay, we're having this portfolio company for a longer period of time. What do we do, right? And one option is to prepare for the exit and sort of convince the future buyer that there is still consolidation potential, right, in that universe. And then otherwise to start to actually activate that consolidation potential, because if you're going to hold that company for another 18 months, well, you have time to do a couple, roll-ups. And so we also see our clients sort of factoring that element of longer holding period into how they continue to create value during that holding period.
And Rob, what's been your experience of sort of direct from sponsor sourcing?
So I think from our perspective, the point is generally sponsor-owned assets are easier to find. Firms put their portfolios on their websites. It's easier to scrape. And so you can find that roster much more directly, which allows you to create this roster. But we do look at sponsor-owned assets that have been in their portfolios for a long time. It just gives you a good sense of what's likely to come to market in the near term. And then you can make an assessment about which companies you may be interested in. Generally speaking, when we're reaching out to other sponsors to have a conversation, it isn't necessarily going to result in a one-to-one deal, but it does give you a little bit better perspective about how they think about the business, potentially introductions to management teams, so that if and when they do enter into a process, you just have a potential leg up over others who might be participating, which is ultimately the goal.
Speaking of competition, Tongi, do you want to take a look at the next couple of slides that we have?
Yeah, sure. Well, I already shared, right, what we call the buyer interest, which is this average number of times a company is contacted by a strategic buyer or private equity to discuss an exit. And what we've done here is we've mapped as well the seller interest, right? And the seller interest is that yellow line that, as you can see, goes down, except for the progressively with the company size, which is basically how willing to engage the CEOs are, right? And how much of a percentage that those CEOs represent of the total number of CEOs that we contacted on behalf of our clients. And you can see the average standing in the range of 17-18%. Going down with the company size, right? Generally, there's a correlation between how many times you're approached and how many times you want to respond positively to a solicitation. There's an element of curiosity here. If you're never approached, you're more prone to engage with a potential buyer or investor because you're more curious. If you're approached on a daily basis, which happens to a number of those targets, then obviously you're going to be a lot more selective, right? And your engagement rate is going to be lower, which increases the need to differentiate, right, from the investor or strategic buyer perspective, because sometimes the CEOs are kind of flooded with approaches, right? So I think that raises two questions. One is, when the companies are very much approached on a daily basis or weekly basis, the messaging, how you approach those targets directly is key, right, to get a positive response in a very competitive market. But as we saw, right, there's two categories of companies: the ones that are constantly approached and the ones that are never approached. And so you want to make sure that you actually give yourself a chance to approach the companies that are not approached, because then your response rate is going to be higher and your ability to engage with the CEOs is greater.
Rob, Nadeem, anything to add to that?
I think Tunky said it really well. You know, this continues. I'm not surprised. It's just it's funny. The more interest they get, the less likely they want to have those conversations. I guess that's the irony of this whole approach. But yeah, I think this is just puts a further stamp on all the materials that we're talking about here in terms of the opportunity and the untapped opportunity and so on and so forth. So I think Tanguy overall has articulated it well.
Good stuff. Okay, in that case, we've covered a lot of stuff so far. We've seen some themes coming through. Let's take some questions now. Tom, do you want to just give people a couple of instructions, please?
Yeah, absolutely. Let's go ahead and open it up for some questions. So to ask a question, please use the Q&A function on screen. All questions will be presented anonymously, but if sharing your name or company name gives some important or helpful context, please do feel free to add it to your question if you feel comfortable doing so. We had a couple of questions come through while we were going through the discussion, so Irv, maybe we'll go ahead and start on those.
Yeah, I'll start with this one. Do you see AI as a viable tool to source a company's likelihood to sell based on customizable criteria that go beyond regular research databases, i.e. aging maturity, shareholder revenue, EBITDA volatility, identifying a listed company expressing its plan to sell off X amount of assets in the coming years? Quite a mouthful, but
This is what everyone wants, right? Whether it's AI generated or somehow the deal that has the perfect metrics and it's the perfect time to buy, they're perfectly interested in selling and you're the perfect buyer, and it just kind of shows up right there, so I think there's two parts to this answer. I'm not sure if the vision articulated by the person asking the question will ever materialize to that extent, given all the inefficiencies we've talked about. But I will say that AI will have a benefit, should have a benefit, private equity, the industry overall. I wouldn't call them on the cutting edge or the early adopters of technology or AI, but certainly us service providers and us CEOs and thinking strategy, both from the position of how to create efficiencies in our business, how to improve our business, how to defend our business from things like AI, and also how to build value to our clients. Like SPS is taking hard looks at these and on both sides. How can we create efficiencies, and how can we improve the user experience and user interface? We have tons of data, right? So presumably, as a data provider, we're in a perfect position to leverage AI to glean more meaningful, deeper, frequent, insights and actionable insights now using that AI. So we're definitely looking into it. I can't speak to the specific vision. I think it's worth exploring, though. I think it is worth exploring to use how UI can build some of those signals, which are just so hard and so ideal to be able to have.
Yeah, I can give it a crack from a different perspective, right? Because over the last 5 years, we've used AI to invent data, right? Because private company data doesn't exist or barely exists, right? And so when it doesn't exist, but you're looking for those companies, how do you make those companies searchable, right? You need to create the content. You need to generate the probability-weighted content that makes those companies discoverable in the first place. Because that's why most of the companies are not identified by strategic buyers or private equity, where they have an investment thesis, but then the difficulty and the challenge is to find those companies. And so that's how we've used AI over the last 5 years, right, to basically populate data. and make those companies discoverable. How we classify companies, how we scrape, how we extract meaningful content, isolate the noise, make revenue predictions and forecast or estimates when we don't have the revenues. And right now, just to give an idea, we cover 203 million companies. We have 139 million companies with revenue or estimated revenue. The idea is that when you do a search, the company will pop up, even though the revenue estimate might be blurry or imperfect, right? It will always be imperfect. But the point in deal sourcing is not to do a KYC or a due diligence, is to make sure you're talking to the right companies. And so AI is a perfect tool to be able to do that. Now, once the data is populated, there is a second level of AI, which is once you have all that data, you can apply AI to sort of do the correlation between there is a deal and there is and here are the parameters of the companies that are actually more prone to making a deal happen, right? And that, with the current state of the data and the private company data, is too early. It won't happen, even in the coming years, right? Where AI is currently useful is to make first those companies discoverable, second, to rationalize the list of companies and be able to sort the companies by relevance, right? And so that's where we are now putting more AI power, in our tools to be able to rationalize the list, because sometimes you're looking for something very specific and you've got a list of 10,000 companies that are potential candidates. And so how you rationalize the search results is another element of AI. And then, as you mentioned, the AI will have an impact on how you interface with the data, right? How you interact with the data, and eventually it will be, hey, Siri, whatever, I need to find companies that are doing that. If you try on ChatGPT, you will not find it, right? Because the underlying data is not there. Right. The point of AI is how much data you put in there, how performing the algos are to generate more data and validate the existing data, and then that's this whole system that makes AI powerful or not, right? So AI without data is nothing, and so the whole challenge when you think of AI is whether you have the data in the first place to train the algos.
I'm going to take another question. We have nearly the end of our time. However, I see most people are still on, so I'm going to take a couple more questions. Rob, this one's for you. What would you say is the percentage split of banked to unbanked deals that you've done, and what are the major things to watch out for with unbanked deals?
So on the first question, I would say the majority of platform deals that we have done have come through an intermediary. It's a very limited number that are coming on a proprietary basis. That proportion flips as you move to add-on deals, that there are a lot more that are introduced by relationships, or you have a extraordinarily limited process. And for us, I think the watch out for any proprietary deal is the time suck. And I think it generally comes in the form of proprietor who isn't fully committed to selling. At the point you've picked a bank to sell your business, you 95% chance you're going to sell the business with a bid in a range. A lot of times we'll have a founder that we have a conversation with who is very pleased and flattered to be shown interest, but ultimately likes that for the sake of that self-validation as opposed to doing a deal. And so that's where you may find out you've sunk 3 months into something that's going nowhere, and that's really what you're looking to avoid.
Tanguy, do you want to add to that?
Yeah, I think as I was mentioning earlier, right, there's never an ideal situation where you give one call to a CEO and there's a transaction 3 months later, right? Sometimes we make introductions to our clients and we learn, a year and a half later that there has been a deal, right? And so it's interesting, of course, when the point is there are several steps, right? One is the identification. You want to make sure you identify the whole universe. The second one is the actionability of that universe, on which, like us as a service provider, we do the heavy lifting. We contact the CEO, we get more information about the company to see if this is actually a good fit for the client. The client is willing to consider it based on that additional information or not. And then we make the introduction. So that heavy lifting is actually a huge game changer when it comes to compressing that time go to a deal. But then I'm not saying either that once there is an introduction, the deal is done, right? It's not, right? There's a lot of work, like seduction, and convincing, and due diligence, and there are plenty of reasons why deals don't go through, right? So in the end, it's as I think Rob said, rightfully so, it's a question of time allocation, it's a question of probabilities. Everyone has a limited amount of time to allocate to the full spectrum of deal sourcing, because you can't really ignore one channel, right? You've got to give a chance to everything. Nadim was saying the opportunity cost of missing a target is massive. It's absolutely massive. If you miss a 20 million target, that is perfect for your platform or for your company if you're a corporate. The opportunity cost is massive. You can't afford that, right? And so putting all the chance, but at the same time playing with the probability and playing with a limited time and money resource to make sure that you sort of do what is the most efficient. You do the 20-80, the 20%, 80% kind of rule across the board, I think is key.
And Nadim, thinking about the PE harvest report and being proactive with direct from sponsor, what are some of the from your experience, what would you advise on that?
So I think Robert said it perfectly, in that it's very rare that this strategy is going to disintermediate, the opportunity, the deal. Private equity firms, understand the principles of the likelihood of getting a higher price, of hiring a bank and having a process and competition and multiple bidders. So occasionally it can result in that one-on-one. It's just the right fit, and you've known them and you have a relationship, and that certainly does happen, maybe like 5% of the time. But really what you're going for in the direct to sponsor is, assuming you have a thesis, you have a certain area that you're focusing on. Now you've identified a handful of private equity assets, the person, it's getting access or information or early look, or access to management, whatever that can give you that competitive edge of whether you want to allocate time. When it does come to market, you know what, that one, we're not going to put a ton of time in, or that one we're not going to put any time. But when that one comes, everything so far has been good, and hopefully, we made an impression on the management team or the private equity team that, we're one of their top 5 choices to begin with, so on and so forth. So that's usually the approach that is taken.
Okay, one last question, and this is kind of going back to the data, just because this whole webinar is based on the data, so I may as well take it. What does the data look like when looking outside of the US? It's a very broad question.
Okay. Well, maybe I think Nadim, your data is more US centric, right? From my understanding.
Yes, we're covering North America currently. Yeah.
And so I don't know. I think what I know of Europe, I mean, on the intermediation part, and then I'll comment on the proactive direct sourcing, right? On the intermediation, my understanding is that the US market is much more mature, much more intermediated, much more, there are buy-side bankers, that you have in the US that you don't really have anywhere else in the world in such a structured way, right? So I think that would be one difference. So the coverage would, if you say what is the percentage of the deals that you would see, I'm not too sure how it would look like in Europe or in APAC. I think also in the US, the ability or the market maturity also translates into more investment thesis versus sort of general sector focus, right? If I can put it this way. And so because of that, the coverage might actually be more at a more granular level in the US than in other geographies. When it comes to proprietary deal sourcing and using the companies, and if I relate to the buyer interest and seller interest, what we see is there is more competition from an investor perspective in the US, right? Roughly speaking, in the US, companies are going to be contacted 25 times a year. In Europe, it's going to be about 12, 13 times a year, and in APAC, it's going to be 6, 7 times a year, right? So there's almost a ratio of 1 to 2 every time you change region, right? So it's a complete different maturity of the markets and level of competitive intensity. The willingness to sell or the willingness to engage from CEOs is going to be lower in the US, higher in Europe, even higher in APAC. And again, it's inversely correlated to the level of maturity of the market, right? The more your approach, the less the less you're willing to engage with everyone, right? And the less your approach, the more interested you are, curious you are. So I think this is the main difference. At least, I mean, there are many others, but based on the data that we shared, some comments that hopefully will help understand comparatively what it would look like in Europe or APAC compared to the US.
Thanks, Tanguy. We do actually have quite a few registrants that are global. We've got registrants who came as far as Australia. So I definitely recommend that you take a look at the data in the white paper. We'll send that out with the recording tomorrow. So we're nearly at the top of the hour, so we must wrap up. So I'd like to finish by asking each of our panelists, what is their one key takeaway from this discussion? Rob, can I go with you first?
Yeah, so I think going back to Tanguy's point that you have to cover kind of both ends of the spectrum and take a holistic approach. I think the takeaway here is you need to be very thoughtful around what data sources you're using to help to improve your efficiency in managing that coverage. And that may be, identifying and addressing the long tail of intermediaries where you're not quite as well penetrated. That may be identifying the untapped opportunity of new companies, but you really need to be thinking about incorporating data into your strategy to be effective use of that time.
Thank you. Nadeem?
I don't have a lot of hard data to back this claim, but I feel 2023, 2024 vintages may turn out to be great periods for PE investment in hindsight, like looking back 10 years from now or whatever. And so given that and how competitive it is and deal flow is kind of light, having the right resources, creativity, technology to give yourself an edge, I think is going to really pay off. It's critical in this time. So that's my takeaway.
Thank you. Tanguy?
Yeah, it's interesting. I was thinking about what SPS does and what we do, and so the complete opposite, right, perspectives and starting points, right? And you always need data with intent. You need a vision on the data so you can build something. And so for me, the ability to build that data set to support the industry in making the right decisions is going to be instrumental. I think one of the objectives, I used to be very passionate about auctions, right? Somehow this is a subject that got me interested years ago, created a company that was an auction company. And I'm looking at this market with a view of the value of the auction, right? And if you're a seller, obviously, as we saw, right, there are proof that it's better to make an auction when you want to sell your company, because you're going to get everyone in the room at the same time, and you get a better price. When you're a buyer, right, and you actually want to create that same mechanism where you have more information than the parties in the room, right? And that's what we're basically doing, right? Trying to say, okay, who are all the interested parties and how you can gather them at the same time so you can make informed decisions. And I think the key learning for me is also one of optimism, in the sense that the private markets are not well covered. The data proves it, right? Whether Nadeem's or ours. And that's very exciting to see how much more we can improve on that as an industry, right? And how much the private equity and the corporates can benefit from those tools to get better in the coming years, right? So I think it's pretty exciting.
Thank you very much. Okay, we're at the end of our time here, so that's a perfect place to stop. So I just want to say thank you very much to all of our panelists and to our audience for your engagement. And I really enjoyed that discussion, and I hope you all did too. Tom, over to you, please.
Yeah, thanks, Irv, and thanks to the panel and the audience for your engagement. Some really good insight and questions there.